I had a little bit of a deep think about what I wanted to present today. So, we've done a number of banks in the past which have worked out quite nicely, and I wondered about doing another bank, and then I thought maybe we should talk about one of the telecom companies like Vodafone, which we've done an awful lot of work on, and we think is very interesting. But I thought I would be a little bit more controversial, and because I think this may be I mean, John and I have talked about this many times, but value investors are starting to be rewarded. In the last 3 or 4 years have been really very, very good for people like us. And I think it's been the easier value ideas that have worked so far, whether it's the shipping companies or whether it was the banks, or I think if the economy in Europe starts to recover as we think it may well do, then there's a whole raft of much more deeper cyclical things which could really start to perform very, very well. So very controversial, I wanted to talk to you today about Volkswagen, where we think there really is a substantial upside. So just to remind you again, because I guess it's probably quite a long time since any of you have looked at Volkswagen, but they are still the second largest car manufacturer. They have a 9% market share behind Toyota, and they're the leading car manufacturer in Europe with a 23% market share. And it may well surprise you, whether it's a good thing or not, but the breadth of the brand range. So all the way from Skoda, which actually is very profitable, right up to Porsche and Bentley. It's really a very broad brand range of not only mass market VW and Skoda, but also much higher margin, much rare brands, must-have brands as Porsche and Bugatti and Lamborghini. And again, just put everything into context a bit before I go into the case, just to remind you. So if we're to look on the first, on the left-hand side, the top row of numbers, just to remind you the kinds of returns each of the businesses make. I think you wouldn't be surprised to see Porsche at the top with a 15% operating margin, but it may surprise you that it's not higher than that if you look at the kind of return that Ferrari makes. You may also be surprised by how profitable Skoda is at 8%. So, mass market, you can make it work if you have the correct cost structure. Audi may surprise you, it's a little bit lower than you might think, but the one where the challenge the group has had for decades now is making VW, the auto brand, more profitable. And you see there at the bottom of the 2% margin, which is disappointing considering the volume, the number of cars that are produced every year. Then the bottom corner, just to remind you again, I think the surprises here is, of course, Asia Pac, 42%, China, a big, big market for VW, 35% of total sales, Europe at 40%. And then North America 13%, South America 6%. So perhaps you may be surprised again how little exposure VW has to America. So VW has faced a number of very significant challenges over the past few years, and just to give you a little bit more context before I really get into the case. So we had this moment in COVID in 2021 where the share price rose significantly, and that was driven by really two forces. The first was the group had an EV Power Day, which really impressed investors, and all sorts of exciting new products being launched and very ambitious targets, profitability targets and market share targets. And it captured the imagination in the context of COVID. And then we had some really very pleasing market share figures. We had European market share reaching 26%, and that was on the back of an unusually large number of new product launches in the years before 2021. So, and then you can see the share price as we go to the right of the chart has fallen all the way back from those dizzy heights of 340 back to the early 90s or so. And the group has faced really three main challenges, and I'd love to address each in turn. And then our contention is that management are beginning to eventually to get a grip on these challenges. So if we look to the first, it's really all about China, and all of you would have read just what a difficult market it is in China for electric vehicles. So in China, Volkswagen still has a 20% market share in internal combustion engine, but they only have a 4% market share in BEVs. And there's been a number of mistakes which the group have made. The first was, I think management was surprised by how quickly the market would develop for BEVs. So they didn't have enough new vehicles. And they also made the mistake of trying to use a similar look of a BEV China look to a European look. And of course, in China, the appetite is for a different shape with a longer trunk, more of an American style design. And at the same time, I think they were astonished by the number of new competitors that have come in to try and manufacture battery electric vehicles. So we have something around 100 now small electric vehicle manufacturers in China. So the competition has been extraordinarily tough. I think the group are now starting to respond to the challenge, and I think they're doing all the right things to rebuild that market share. And I think there's a very good chance they may well succeed. So the first thing is the introduction of the China main platform, and this is really a complete reworking of the whole production process and should lead to a 40% reduction in production costs. The next really important thing is all around technology. Now, one of the mistakes that VW made in the past was the technology was developed in Germany and it was adjusted for China and Germany and then brought over to China and used in Chinese vehicles. And of course, the Chinese consumer has a very different appetite. They want different things like in-car karaoke and there's a look which VW weren't satisfying. So they created the Volkswagen China Technology Company, and that means that largely most of the technology platform will now be developed in China for China. And the other very important thing is they've done a joint venture with Xipeng, and so in fact a number of the Audis will be new Audis will be developed by Xipeng on a much lower cost platform. And then if we go to China too, I mean, what's quite interesting is, and this is of course the challenge of what is an extraordinarily competitive market, but our guess is that's beginning to ease, and just to remind you, VW I think is the only profitable car manufacturer in China. If you take away BYD's battery operation, then they're losing money as well. And so I mean, a lot of these manufacturers are local and not quoted. It's difficult to find the data, but we think the majority are making a loss of something between 25 to 35% on operating margin. So massive, massive losses. And VW is highly profitable. It's got a very strong balance sheet, so they should be able to they have the firepower to be able to at least have a go at becoming more competitive and building an enduring market share in battery electric vehicles in China. I think maybe more encouragingly is we've had the anti-involution campaign led by the government. I mean, clearly the car industry has been singled out as a ruinously difficult price war, which is challenging the whole industry. And what the government have proposed is that dealer margins should be reduced from anything they were up to 25% in the past to 5%. And one of the problems was that dealers were dramatically reducing their margins in order to try and encourage sales, further pushing down prices. Days payable have been forcibly cut by the government because the terms were just too generous. And it allowed that kind of thinking of, well, it'll get better, it'll get better. We'll put out until we pay for the car. It'll get better, it'll get better. Weakest dealers have been eliminated, but maybe most important of all is cars should not be sold at below cost. So if we go on to China 3, we have now a whole raft of new cars which are going to be launched. As I said, there'll be some of the Audis on the Xipeng production platform, but there'll be in totally 30 new BEVs to be launched by 2030. And these have a crafted China look, and they'll also include the software, the new built-in China software for China consumers. And our guess is that this should enable VW to start to regain some of that lost market share. It's very interesting. We had the Shanghai Motor Show recently, and this new range, this new set of launches, really very well received. And it looks as if Volkswagen's market share in BEVs has started to increase again. Our hope is that they'll be able to get back to something like a 10% market share when the market competition eases. We think there'll be a number of mergers with the industry. We think a number of the weakest players will go bankrupt, and Volkswagen still has a very desirable must-have brand name within the industry. So whilst it's brutal and difficult, the environment, it seems to be to us, there are signs it's starting to get better, and there could be a way through for Volkswagen. The next big challenge is Europe. Now, this is clearly It's been a problem with Volkswagen watches for years and years. VW brand has never really been able to make the kind of margin it should be able to make. And what we've been very excited about was we got to this kind of low point in the run up to the end of last year. And I think we were all surprised by how management managed to get a deal with the unions in order to restructure the business in Europe. And we had the Zukunft in Volkswagen in December 2024. And I'm still surprised by how deep the restructuring has gone and what unions were prepared to agree to. But the first thing which will surprise all of you is Wolfsburg capacity is being reduced from 4 lines to 2 lines. And Wolfsburg, as you can see in the pictures, is this vast production plant. And whilst it's efficient, it still has suffers all the disadvantages of being, of German costs and regulation. We had the Golf and Golf estate production for the first time ever now moving to Mexico, where it'll be exported around the rest of the world. The wage increase, 5% wage increase, will be suspended until 2030. No bonuses will be paid this year and next year. But most dramatic of all is 35,000 German jobs will be cut. 35,000 German jobs. And that's 25% of total German capacity. That'll bring VW's capacity down to the level of sales where it is today. So really very, very significant. All in all, the December plan takes out another 4 billion of costs, and added to previous restructuring programs, we've got 15 billion of costs coming out in total. So we think this is a very important move to try and get VW brand profitability back up to where it should be, should be 4 or 5 or 6%, not the 2% where it is today. And I think the last great challenge, of course, is technology. And our guess is that this is more imagined than real. So there's been a repeated talk about Volkswagen being behind on technology. But as far as we can tell, with all the work we've done and speaking to experts, the gap has really very significantly narrowed between all the car manufacturers. The one of observation we've seen is that many of the people we speak to would say that Tesla now has fallen quite far behind most of the rest of the competition. Certainly on the kind of levels of autonomous driving where we are today, and it seems to be rather a clunky product, although fully autonomous, they may have some advances. So what VW have done is to realize that doing it all in Germany perhaps was not the best way, and throwing a great deal of money at it. And they've done really two very important things. One with Rivian, which your American listeners will know, and with Xpeng. So the second generation of Rivian software will reduce cost by 80%, and that's really important. And then Xpeng has got a very efficient cost structure for their software, which will be introduced on the number of the VWs, Audis rather, in China. They've done this approach of make and buy, so very pragmatic. If they can buy them as cheaply as they can, they'll do that, but also wanting to make batteries as well, but not go for fully making batteries if there's more cheaper batteries they can buy from outside. I think we touched on the other very important point was Car Thunder. It's all about localizing in-car software in China. So it's the look. It's got to have a Chinese look in China. And the problem in the past was it was just the look was too European. I think the other really important thing is VW now have a very reasonable, a fully autonomous driving solution, MOIA. And maybe the last remark is just in Europe, market share now for VW for BEVs is 25%. So they're succeeding in Europe for BEVs. And just maybe to surprise you all, but the ID. Buzz, the fully autonomous ID. Buzz, it's a very nice product. And they won the contract for Los Angeles in 2026. There are only two other companies who are able to run an autonomous. Waymo, of course, the most famous, running autonomous vehicles. And we've really been quite impressed by how VW have been able to pulling together technologies from outside and their own technology to produce what is really rather an elegant looking, fully autonomous robo-taxi. So, of course, VW have taken a different approach to Tesla, who are trying to do the whole thing in-house. They've done more the kind of Waymo approach of building, pulling in technology from the outside. And I think that more pragmatic approach, who knows, may well prove at the end to be the most successful outcome. So three really big challenges. It's all about, China. Can you in a very competitive market, can they find a way through this? Is there a light at the end of the tunnel? And we think there is. They've done a lot of work on costs, on making the software look Chinese friendly. We see that competition is beginning at last to ease. The government's doing a lot to try and make it, make it harder for some of the smaller companies to dump vehicles at any price. And our guess is there'll be significant consolidation in the sector, and the remaining players should start to generate reasonable returns. Europe, the unthinkable, the restructuring in Wolfsburg, we've seen, and of course, technology, we think a more pragmatic approach using other manufacturers and mixing it up with their own technology. This comes on to the valuation. So this is really, really difficult. And I mean, I've tried to do it a number of different ways. I mean, the first way, which I haven't shown you here, which is really hard, but if I just work through all the cost cutting and with not much volume growth and recovery, then